This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. Asia is set for a weaker open as the US holiday hits pause on Wall Street's tech-driven rally. Japanese bonds in focus, with the finance ministry weighing a plan to shift to shorter maturities. Also ahead, we assess the likely impact of China's central bank taking a more active role in bond trading and what could be its biggest policy shift in a decade. Plus, a Mexican restaurant chain started by a New York expat set to list today on Australia's stock exchange at a $1.5 billion valuation. All right, let's get you straight to today's agenda. And really, it is about the reaction, Shery, of the PBOC's new tools that were announced. And we've been waiting for sort of more forceful action from the PBOC, from policymakers for quite some time. China's looking at implementing PBOC's role when it comes to bond trading as one of sort of the top headlines that we'll be watching out for, particularly when it comes to the reaction across bond markets. But it's broadly sort of more suggestive of supportive policy with limits. We had that 20-minute speech by the People's Bank of China Governor Pan Gongsheng, hammering home that message that the PBOC is veering away from what might be considered a more traditional way of stimulating the economy. So he's been speaking this week at the Lujiazui Forum, and he's spoken about the monetary policy stance as being accommodative, rejecting the idea that the groundwork is being laid for more traditional quantitative easing. So it's a lot more for investors to sort of contend with, Shery, but perhaps the floodgates are not open for more traditional easing just yet.
It's really all about the central bank's ability to really help the government's coffers, right? We have seen more when it comes to strained government finances around the world. And perhaps one indication here in Japan is also the finance ministry wanting to shift bond issuance to shorter maturity, saying that they want to reduce the amount of yield risk, according to a draft proposal seen by Bloomberg. And this, of course, coming at a time when the Bank of Japan just announced a decision to cut the debt purchases. So take a look at how we're setting up for the market opens, because we have seen those JGBs take a hit on the report by Bloomberg about that proposal coming from the finance ministry. But there has been already a lot of volatility because markets have been trying to digest government Ueda's comments, not only from last week with the BOJ policy decision, but this week at Parliament, leaving the door open for July rate hike together with those reductions of debt purchases. And in the meantime, we're following futures markets trading like this. Nikkei futures down 0.7%. Sydney futures also getting hit before the open. But of course, we've been watching the New Zealand economy as well, because we have seen that pressure in the markets at a time when the New Zealand economy has finally been able to emerge from recession by growing 0.2% in the first quarter. Also, take a look at how we're setting up when it comes to the future space, especially in the EM complex, because we have been following those currencies under a little bit of pressure despite more risk on sentiment around the world, especially on the Brazilian real. We just had the Brazil Central Bank announce that they will be holding rates steady. The decision was unanimous. They have seen a little bit of a pickup in inflation, so they have halted that easing cycle. Of course, we're coming off a holiday on Wall Street, but futures pointing to the upside, Heidi.
Let's get some analysis when it comes to what we've heard from China, Shery. And our next guest says there's a good chance for the Chinese equity market to make a comeback this year. Joining us from our Singapore studio is Jun In-Yoon, who's the founder and CEO at Fibonacci Asset Management Global. Really great to have you with us. So I'm keen to get your thoughts on what you make of the latest communications from the PBOC governor.
So Chinese government has been trying to prop up the capital market in China for some time. And we all know that the real estate sector went through havoc last year and early this year as well. And it will take many years for real estate market to recover. However, in the financial market, we are seeing a little bit glimpse of hope as we saw the first quarter Hong Kong stock market rallied. And the people are questioning whether this strength can continue to the second half. Judging from the economic data that we are seeing, we had an upside GDP growth. We also had a good inflation data coming in. So I think the recovery is starting, and we are nearing, or we are already past the inflection point for the Chinese equity market. one of the sector that we really watching is the AI sector in China. AI stocks in China has had a decimating loss last year. Some stocks are as low as 80%. And when the comeback starts in the second half, we think that there will be a significant rally in the AI stocks.
So when you take a look at some of the themes that you're constructive on, including AI and sort of more broader China tech, are these themes sort of agnostic to what the broader monetary policy framework is? We have seen sort of these hints that there will be a new toolkit for the PBOC. This is a new kind of potential framework on how they manage money and potentially more easing to come as well. Do you think those opportunities are impacted by what the central bank does?
I think early this year, when China Central Bank was introducing some measures, people were not paying attention. However, this new tool of intervening in the bond market I think it's a decisive move, and it could be a game changer. This is what the market's been expecting to hear and wanting to hear from a Chinese bank. And I think it will have a very positive effect, not just on AI, but on the broader stock market in general.
How much of all of this matter for tech stocks in China, given the incredible rally that we've seen globally?
So early April, we actually liquidated most of AI position we had because we believe that the rate cut expectation for U.S. is diminishing. We bought them back again because a lot of the expectation for no rate cut or one rate cut was priced in. At the same time, we saw the rally in Chinese stocks, and we believe the recovery of demand in AI in China will affect the AI market in general. It will probably a very healthy boost for the AI tech companies to have a sustained level of revenue growth going into the second half. So this is all very positive.
Not to mention perhaps the energy sector as well, right? Because you really need a lot of power in order to sustain those AI infrastructure investments that we're going to see.
Yes, so if you look at the recent AI rally, much has been done based on the expectation, but if we want to see more sustainable rally, it has to be adequately supported. And what's making the AI revolution possible is the infrastructure that supports it, and mainly the electricity. Our current electricity infrastructure is not adequate to support AI growth in the future. Therefore, we think energy transmission, energy generation, and energy storage technology is worth paying attention. Some of the stocks that we are putting in our watch list are Korean energy stocks like KOGAS or Ares Electric and Doosan Ability.
What about Korean defense stocks at a time when we're seeing more geopolitical volatility? President Putin now in Vietnam, was in North Korea just earlier. I really haven't seen a lot of movement anytime we have North Korea related news in recent years, but what are you seeing the potential of these stocks to be?
So what we are seeing now is, United States enjoyed a supremacy of power for many decades, and we're seeing that slowly coming down to decline. And starting from Ukraine, there's also tension in the Middle East. So countries nearby Russia, such as Poland or Romania, are already increasing their defense budget. Saudi Arabia and United Arab Emirates have been amassing military assets. So it's a natural reaction for the world leaders to think about how to defend itself in the future, and that is a positive flow for military defense stocks in Korea. So in Korea, we think there will be a healthy flow of cash coming in from both Europe and Middle East. And because of that, I think Korea defense stocks are worth paying attention. In our radar, LIG Next One, Hanwha Aerospace, and Hanwha System are positive.
How closely are you watching developments in Europe?
So there's some concerns I have over Europe, and it's about French election. Now, many years ago, when we talked about term Brexit, most people didn't know what that meant or thought that the chance of Brexit was so slim we can ignore about it, but it actually happened. Now, in a few weeks, there's an election in the French Parliament, and I think there's a very high chance that far right will take over the control. And once unthinkable scenario might span out, people start asking questions like, okay, who's going to be the next French president in 2027? And what are the policies that will be rolled out? And how will the new French government cooperate with Brussels? And one of the policies these far-right parties are pushing for are anti-immigration, anti-free trade, and they're not even supporting to support Ukraine to fight against Russia. So this is what everything EU is not about. So it may be a harsh contrarian view, but we think there is actually a very slim possibility of Frexit coming in a few years. And we are already seeing the reaction of the market from the French bond market. If you look at the French bond market, the yields have spiked. And if you look at the share price in SocGen and BNP, it's already down by more than 20% over the month. So this may be a starting point where people are starting to assess the possibility of any disruption in the French market. And even without Frexit, if we have 1% increase in a French government bond yield, that's going to create some shockwave to the banking system. And that's probably the reason why the share price of SocGen and BNP is shaking.
Yeah, we have seen that spread also between French and German debt at the widest since 2017. Chung In-yoon, good to have you with us. Founder and CEO of Fibonacci Asset Management Global with his perspectives on the markets. And coming up on the Asia Trade, we speak to Orbis Investments about their outlook on Japanese stocks. Hear why Citi Wealth thinks muted volatility levels have made hedging strategies attractive. Also, Grow Investment Group's Hao Hong joins us to look at the PBOC's potential strategy shift on bonds and interest rates. You're watching the Asia Trade. Vietnam has welcomed Russian President Vladimir Putin after he arrived in Hanoi on Thursday following his visit to North Korea. Our East Asia government editor John Herskovitz joins me here in the Tokyo studio now. John, let me get to Vietnam because it's been interesting. Vietnam has had a decades-old relationship with Russia, but at the same time, it's achieved immense growth by partnering up with the West as well. How does this relationship look now, and what can we expect from this visit?
I think we're going to see Russia looking at its energy investments in Vietnam, and Vietnam trying to play off Russia, China, the U.S., and by strengthening its alliance with Russia, its partnership with Russia, it gives it a little bit more leverage when it's dealing with the U.S. and China, because it's one more partner, more money coming in. So it's something that we're going to see. It's advantageous for Vietnam, and also for Putin. It's an ally. It's someone who can help with this economy, and perhaps there might be some military security.
And it's such a complex relationship because Vietnam has its own issues with China at the same time when China is still very close to Russia.
Exactly. It's one of these delicate balances. And one thing about this trip in general is Putin is really putting on an Asian focus. It's reasserting Russia's influence in the region. The visit to North Korea was monumental for the two countries. And then there's this follow-on with Vietnam. He's picking two instrumental countries in the Soviet era, going back to them and trying to use them to build future strength.
Has Vietnam played any role in Russia's war in Ukraine?
It doesn't look that way. The biggest influence has come from North Korea in this region. North Korea just has so much in terms of armaments that Russia has and needs. It has old Soviet-era systems. It has artillery shells, millions of these that have been shipped over to Russia, according to South Korea and the U.S. It has a lot of what Russia needs.
East Asia Government Editor John Herskovitz there. Well, China is said to be preparing a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. The likely targets include alcohol, cars, many different food items. For more, let's bring our Chief North Asia correspondent Stephen Angle in Hong Kong. And, Steve, with this scenario, there's been a lot of concerns about a revival of trade wars, right? What are we hearing?
Well, what we do know is that the European Union basically is going ahead or will go ahead with about 48% tax on those Chinese EVs. And there is said to be, through state media, as well as hints from the Chinese government, that there's going to be retaliatory action, probably more targeted this time, much like what China deployed against Australia, and that is against alcohol items and foodstuffs, products that China can source elsewhere. So if they levy these tariffs on Europe, here are some of the areas that would hit Europe the hardest. I just mentioned about alcohol. Well, France is the biggest producer of brandy. Wine could also be targeted in those Mediterranean nations, particularly France, Italy, and Spain would be hit very hard. Brandy, Beijing already announced a probe back in January, an anti-dumping probe back in January, which could take a year or so to be fulfilled, but that does not mean Beijing could not, in the interim, impose preliminary tariffs, much like what it did on the Australian wine sector when it launched a probe there. Then, of course, France is China's second largest brandy export market, so it would hit France quite hard. That would also play out as well for wine. I mentioned Australian wine, but of course, France, Italy, and Spain, big producers. And wine right now is at a historical global glut. So again, other producers could fill the void there. Now, pork, Spain is the number 2 market to China is the number 2 market for Spain in pork. That could be targeted. Also, dairy, that would hit Denmark. And then cars. We're already hearing from state media saying that the Chinese car makers are pushing Beijing government to employ about a 25% tax on large engine European cars. That's going to hit Germany pretty hard.
There's a reason also that these measures are targeted, right? Are there any products that China might avoid retaliation because they actually need those items?
Sure. I'm sure there's going to be an exclusion list, and in particular, let's bring up airplanes. Airbus is one of 2 main suppliers globally, obviously. And also, look, the Chinese right now are said to be in negotiations for about 100 new wide-body aircraft from Airbus. Those are not the single-aisle planes that they assemble in Tianjin. They would have to buy them from Europe. They're not about to put a tax or tariff on items that they're about to buy and import into China. Also, any penalty against Airbus would be a benefit to Boeing. We all know that Boeing and China right now have their difficulties, and the U.S. and China are in that trade spat as well. So this is an area that would probably not see tariffs at this time.
Chief North Asia correspondent Stephen Angle there in Hong Kong. China's banks are expected to keep their loan prime rate quotes unchanged for a 4th month in a row when they fix the benchmarks in a couple of hours' time. Let's bring our China correspondent Min Min Lo. And Min Min, there's no sign of interest rate easing today, and particularly interesting in the context of the comments we heard from the PBOC governor.
That's right. We're expecting the loan prime rates to remain at just under 3.5% and 4% for the 1-year and 5-year respectively. And that's mainly because the PBOC had held the MLF rate steady on Monday. And commercial banks are not likely to cut rates when their funding costs have not been lowered. That's just going to eat into their profit margins. But there are strong arguments for the PBOC to ease, though, given low inflation and the fragile economic recovery. Our expectation is that PBOC will cut rates after the Fed goes first, just to lower pressure on the yuan, and commercial banks tend to follow in lockstep after that, so they could possibly cut the loan prime rate maybe closer towards the end of the year.
But what we've been really watching has been PBOC Governor Pan Gongsheng's comments in Shanghai, right? When it comes to sort of overhauling their interest rate policy, their really bond purchases as well. How significant is this?
Yeah, it is going to be one of the largest overhaul that we've seen in years because bond trading is seen as perhaps a more effective tool compared to the current instruments because it affects a broader swathe of market participants. It obviously also boosts the government's ability to raise funds for public investments, and that's critical at a time when local governments' financing has been very tight, which crimps their ability to kind of boost the economy. And as you said, there are interest rate reforms to look out for as well. The PBOC is said to be looking at using a single short-term rate to guide markets, and that's going to reduce the reliance on the one-year policy rate, which is the MLF, that was introduced a decade ago. They're also said to be considering to tighten the interest rate corridor within which market rates can fluctuate. So these are just additional measures that allow the bank to fine-tune monetary conditions without resorting to perhaps what the market could see as more aggressive easing. So that's why the PBOC has been so keen to mention that this is not equivalent to quantitative easing because they really want to avoid the kind of market distortion and financial risks and inflation fears that come with that.
The securities regulator, meanwhile, also announcing plans to shore up the STAR market.
That's right. So the STAR market is China's version of the NASDAQ. It was created in 2019, and trading has been sluggish since it was created. I think the benchmark index has been down 50% since 2019. So the government is announcing an 8-point plan, which includes measures such as increased financing, tightening supervision, encouraging mergers and reorganizations, and prioritizing listings of companies with breakthroughs. And this is really part of broader measures to boost China's $9 trillion stock market that saw consecutive losses in the last 3 years. And the new securities regulator, he was appointed in February. He already came out with some aggressive policies, including cracking down on market manipulation and fraud, taking aim at quantitative trading. So those have borne some fruit so far, and the new measures are likely to also add to help lift sentiments among investors.
Our China correspondent Mei Min Lo with the latest on China, of course, that look ahead to LPR decisions today. More ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade. Here are the latest from the corporate front. Thousands of car dealerships in the U.S. grounded to a halt during the Juneteenth holiday on Wednesday. That's after major software provider CDK Global shut its systems following a cyber attack. Many car dealerships depend on the firm's systems to conduct their business. CDK says its dealer management system and digital retailing solutions have since been restored. European automakers are readying new EVs across the price spectrum as Europe prepares tariffs to protect its auto industry. Citroën plans to sell its second electric model for less than 28,000 euros to compete with cheaper models from Chinese brands. Meanwhile, Ferrari's first EV is set to cost at least 500,000 euros. According to Reuters, the price doesn't include options and compares with about 350,000 euros for an average Ferrari. The Australian government is planning to introduce ESG labeling requirements in its fight against greenwashing. Authorities will establish labels and disclosures for investment products. This is Bloomberg. This is the Asia trade. We're about 30 minutes away from the major market opens. Here are the top stories that you should know. China is said to be readying a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. The likely targets may include alcohol, cars, and many different food items. Keep an eye on U.S. Treasuries as cash trading resumes. A Bloomberg gauge of returns in the asset class is now down just 0.1% for 2024. That's as investors bet that cooling inflation will convince the Fed to cut sooner and by more than officials have signaled. Right, the draft proposal seen by Bloomberg shows Japan's Ministry of Finance is weighing a plan to shift more of its bond issuance to shorter maturities. That's a major change as the central bank moves to cut purchases of government debt. For more on Japan's bond issuances, let's bring in Asia Economy Senior Editor Brian Fowler. Brian, how significant is this as we're headed towards a shift from the BOJ as well?
Yeah, it's a pretty big step. It's all part of the changing landscape for policy in Japan. Of course, as you know, with interest rates having been so low for so long, both the policy rates on either side of zero and longer rates controlled via the yield curve control mechanism, it really wasn't an issue for a long time. Japan was issuing debt with longer and longer maturities, up to 40 years. Now, with the BOJ having announced that it's going to cut its bond buying, Japan needs to find a slightly wider pool of potential buyers for all this debt that it's issuing, and it's specifically targeting banks with this proposal. So the idea is to short maturities, which would carry less interest rate risk for purchasers, and also consider possibly rolling out more floating rate debt. Right now, Japan sells 10-year floating rate debt marketed to individuals. The idea would be to shorten the maturities on that and market those to institutional investors, including banks.
What could be the broader implications of this?
Well, I mean, on the one hand, you know, this could be a little bit of potential help to the yen if it channels more flows that might have gone previously overseas to U.S. treasuries, if it convinces banks to maybe put more of that, keep it at home in JGBs. Could also attract some funds from overseas if overseas investors now think that it's a little bit more feasible in terms of risk management to buy more of this debt. So there's that, and then I mean, I guess what it really tells us is Japan is gearing up for the likelihood that interest rates really will continue higher. I mean, right now we're still obviously just barely above zero, and where we've been for a couple of decades. But it looks like policymakers are convinced that there is going to be some kind of a liftoff here that's sustainable.
Our Asia Economy and Government Senior Editor Brian Fowler there with a changing landscape across Japan. Let's discuss where the opportunities are, especially in the equity markets here. Joining us now, it's Tsukasa Tokikuni, Japan Office Representative Director and President at Orbis Investments. And we can see those two top holdings for your firm. But tell us a little bit about the rationale behind your investment strategy, because you have shifted from some of those trading companies that you used to hold now to more traditional Japanese manufacturers as well.
Sure. Our investment philosophy is to invest in stocks which are traded well below their intrinsic value. In general, in investing, I see just two factors to look at. One is the price, and the other being the intrinsic value of an asset. And if it's a public company, you know, price is a given. So we just need to pursue the intrinsic value of a company. And when it comes to Asahi Group, our top holding, we believe that it's traded well below its intrinsic value.
So where are those more valuable stocks at this point? Because we have seen such a run-up in Japanese equities. If you were to pinpoint to some of the sectors that investors should be more focused on, where would those be?
Sure. We believe it's more. It would be better to look at companies by companies. There are idiosyncratic alpha opportunities in the Japanese equity market, as you rightly pointed out. If you look at the whole market, it's been up, but if you look at company by company, there are still quite a good alpha opportunities.
Some of those holdings you told us about Asahi. What are some of the other companies, and do you find them in the large cap sector, in the small caps, mid caps? Because the rally has very much focused on some of those bigger names so far.
That's right. Yeah. We see opportunities in both spaces, both the large caps and mid caps. Interestingly, in the history of our fund, we have overweighted the large caps, but currently we actually overweight the mid caps, just because, as you rightly pointed out, the large caps have been good in the recent year.
Can you tell us a little bit more about the manufacturers that you're constructive on right now?
Sure. If you look at our top 10 holdings, actually we hold a number of Japanese sort of traditional manufacturers. They are good companies, and actually there are hidden growth behind these companies. If you look at the whole market, a lot of people are concentrated on the likes of artificial intelligence or IT companies, which are quite glamorous stocks, if you will. These Japanese manufacturers, you can't forget about these companies. These are really high-quality companies. If I were to point out a few names, it would be Asahi Group, Kubota, or Yamato Kogyo. You might have not heard about Yamato Kogyo. It's located in Himeji City in Hyogo Prefecture in Japan. It's in the western part of Japan. It's a steelmaker. It has a good quality business. It has generated 20-year consecutive profitable P&L with 10%, more than 10% return on invested capital, while it's been traded below 1 time PBR and 9 times forward PER.
And for the Japanese banks, I mean, the domestic rate environment, the domestic fees environment, wholesale and retail are both looking pretty optimistic. Have you trimmed your holdings, or is that still something that's of interest?
Yes, actually, we have trimmed holdings. If you looked at our top holdings in 2 years ago, SMFG and SMTH were in the top 10s, actually top 5s, but they are not in the top 10s anymore. We still hold these stocks, but they are not traded that much of a discount to their intrinsic value, we believe, and therefore we partially trimmed the positions.
You told us that you're sort of veering away from those glamorous stocks, those sexier perhaps in the tech sector, especially with all of this frenzy over artificial intelligence.
Right.
How do you view that?
Yeah, it's totally understandable. And it's interesting that the story around growth, we believe, is true. And it's going to happen. They're going to grow. They are excellent companies. But once these stocks are popular, the thing is the price comes up quite a bit. So no matter whether a company is great or not, the quality is high or not, if the price is too high, then it's not a good investment. So a good company is not necessarily a good investment.
Is there fear of missing out with something like the AI rally?
Spot on.
What do you think of that fear of missing out?
But you don't have that fear, right?
Exactly. Yeah, we're a contrarian investor, and we don't have fear of missing out. It's again totally understandable with the low interest rate environment. The long duration stocks are getting popular, and the price have been backed up by the low interest rate. And if you look at the growth stories around these artificial intelligence companies, it is true. So it's natural that people get attracted to these stocks. But again, I believe it's very important to look at the intrinsic value of these companies and compare that against the price of the company. And if it's not cheap, I don't think it would be a good investment.
Tsukasa Tokakuni, Japan Office Representative, Director and President at Orbis Investments. Really great to have you with us. Still ahead, we take a look ahead at the listing of the restaurant chain aiming to bring burritos and tacos to 1,000 locations across Australia. This is Bloomberg.
Australia's biggest IPO in a year has investors betting big on burritos. Guzman y Gomez is a popular Mexican-themed restaurant, famed for its burritos and its bowls. The firm is listing in Sydney after an IPO that has raised $223 million, considerably more than the company and shareholders initially planned for. Australia hasn't hosted an IPO that big since July last year, and offerings from the food and beverage sector have been very rare. The chain was founded here in Sydney in 2006 and now has about 185 stores across Australia. Around the world, it has 9 in Japan and the US and 17 in Singapore, its biggest market abroad. Part of the IPO money will be used for expansion in Australia, but some analysts eyeing the IPO are sceptical it will be easy to keep a strong pace of expansion beyond the next 10 years.
Take a look at morning calls ahead of the Asia trading day getting underway, and a JP Morgan analyst is turning bullish on Chinese tech stocks after previously questioning the sector's investability. Alex Yao says he now sees a roughly 20 to 25% share price upside due to improving cost structure and less aggressive competition. Yao also notes that macro developments are key to stabilizing the share price trend. Citi, meanwhile, says AI will probably displace more jobs across the banking industry than any other sector. Its new report says about 54% of banking jobs have a high potential to become automated. An additional 12% of roles across the industry could also be augmented with the technology, but it also believes banks will have to hire more managers to ensure their use of AI is in line with regulations.
Heidi, we're in the thick of really annual shareholder meetings here in Japan, and Toyota chairman Akio Toyoda has been reappointed with his lowest support on record as an ongoing safety investigation drew opposition from some shareholders. Transport reporter Nicholas Takahashi joins me now with the latest. And Nicholas, the message seems pretty clear from shareholders. They're not very confident about him.
Yeah, I think that's about it. The results sort of speak for themselves. The record low last year was 85%. The year before that, it was a 96% vote. So the drops have been significant from year to year. This year, we saw about 72% of shareholders voting for the chairman's reinstatement.
Does that affect the way that he can perform and conduct his business?
I think so. And on the other hand, I think it reflects that maybe shareholders, or a growing number of shareholders, think he hasn't been conducting his business as well as they'd like.
And we have already seen some, say, mega banks trying to divest from Toyota as well. What's the message there?
Well, the message there, and maybe it's more about the implications for meetings like this at big companies like Toyota. Japan has been pushing for large corporations to divest strategic shareholdings and to unwind their vast web of cross-held shares, and this is the biggest sign yet of that. What that means for the annual shareholder meetings of big companies like Toyota is that in the absence of, let's say, stable long-term shareholders like two mega banks, what Toyota loses is that longevity and that support that they've been depending on for decades, and that could mean that the voices of other shareholders ring louder.
There's also the vehicle safety certifications probe, right? What do we know about this and what happens next here?
Well, there were 5 Japanese car makers initially roped into this ongoing safety verification scandal. Of those 5, the only remaining investigation still ongoing is that of Toyota. We might see the results of that within the coming weeks, but for now, Toyota has said that they're suspending the shipments of 3 vehicle models through the end of July. That could be extended beyond that as we wait for the investigation to reach a conclusion, but there have been reports about how these infractions within Toyota also might violate UN standards across 62 countries and regions. So while it's unclear what the operational impact is of these faulty certifications, I think there's room for it to expand further.
How is Toyota doing business-wise?
It's been a great couple years for Toyota. They've been breaking record after record. Operating income reached $5.4 trillion during the last fiscal year. It's the first time a Japanese company has ever beat $5 trillion, and it's the highest ever for the nation. Besides that, Toyota's production and output has exceeded 11 million units during the last calendar year, which is a record. Toyota protected its title as the biggest car maker in the world, beating Volkswagen for a 4th year. So on paper, it's been fantastic stretch of years for Toyota, but then in the background, these results are casting a shadow over what might have been avoidable with these faulty certifications.
A bit of a challenge there for Akio Toyoda. Great to have you with us with that context. For Toyota, transport reporter Nicholas Takahashi. And we have more ahead on the Asia trade. This is Bloomberg.
A Mexican restaurant chain started by an American expert is set to list on the Australian Stock Exchange today with a valuation of $1.5 billion. Our Asia stocks and credit reporter Georgina McKay is with us now. So many puns around this, right? But investors betting big on burritos, clearly. So why is this significant for the deals market?
So firstly, the IPO market in Australia has been extremely subdued over the last couple of years. And this IPO of GYG is the largest in about a year. And so there's been extreme interest among shareholders. And it's also from the initial size that was planned, it got raised 40%. So there's been a lot of excitement surrounding this, and I think everyone's very keen for when shares start trading at 12 p.m. in Sydney today.
What are they planning to do with the proceeds?
So part of the plan for the proceeds is expansion. So the founders have been talking about this widely, and they want to open 1,000 stores in Australia, which is quite ambitious. And there's a plan.
There already is quite a few. I mean,
yeah. So there's 185 in Australia, and then we've got 17 in Singapore. One opened just a few days ago, which is their largest market abroad. And then across the US and Japan, there's another 9 stores. But yeah, there's big, very ambitious plans, and some analysts are a bit sceptical on that growth path, if they're going to be able to sustain that sort of level of growth.
I made a point of eating as much Mexican food before moving to Japan because I knew that was going to be a scarcity once you get to Asia. Tell us about those expansion plans and the appetite, I guess, that there is among the Asian public for these Latin American dishes.
So within Australia, you can even see I visited a few GYGs in preparation for this video. In preparation for this IPO, so I've also been consuming quite a bit of Mexican food. But I think talking anecdotally to colleagues and just people around the region, that there isn't a great level of offerings compared to somewhere like the US, where you have various chains that are offering similar kind of food to GYG. But for places like Japan and for Singapore, there isn't really equivalent. And we've got colleagues in Hong Kong complaining that there are no offerings there. So yeah, there's certainly appetite amongst consumers, and that's why driving these growth plans, and then also among investors for an IPO of this size, which we haven't seen for quite a while, really.
And it's interesting, the people behind this, they're not necessarily F&B kind of beginnings, right? They're hedge fund traders.
Yes, so one of the founders, Stephen Marks, he is a former hedge fund trader from New York, and he moved to Australia in the early 2000s. And I think it's in his own words, he thought that the Mexican offerings here were dismal. So he, with his co-founder, Robert Hassan, who was a fashion wholesaler, they opened up their first store in 2006. And then obviously that's expanded exponentially since then. And yeah, it just was born out of a passion for quality Mexican themed food.
Yeah, it's a big IPO for they want to sell a lot of $11 burritos.
Yes.
I guess. Asia stocks and credit reporter Georgina McKay. That of course comes online at midday Sydney with that deferred settlement basis when it starts trading. An ETF investing directly in Bitcoin, meanwhile, will also list on Australia's main stock exchange for the first time today. Bloomberg Intelligence says that could help bring nearly $1 billion of assets into the nation's virtual asset ETF. So BI ETF analyst Rebecca Sin joins us now. So, Rebecca, what do you see as the biggest impact of this listing?
So I'm going to have to say, between burritos or crypto, I'm going to have to pick crypto. And I think the impact to the Australian market could bring as much as $1 billion. You're going to have to eat a lot of burritos to get $1 billion worth of. But ultimately, this is the first spot Bitcoin ETF that's going to list on the ASX today by Van Eyck. And so for those that may not know, on CBOE Australia, there was already previously 3 Bitcoin and Ether ETFs, and those were listed by Global X21 shares and Monochrome. And so this now allows investors access to Bitcoin across not only CBOE in Australia, but also ASX. And the main importance of this is that ultimately, if your product is listed on ASX, it will also be listed on CBOE, but the reverse is not true. And so for those ETFs that were listed previously, like Global X21 shares, Bitcoin and Ether ETF that was listed in 2022, those are only accessible on CBOE. So the potential for this is huge. Across Asia Pacific, we've seen a lot of interest, and globally for virtual assets. You may recall earlier this year in January, the U.S. had spot Bitcoin ETF launch, and that has amassed more than close to $20 billion worth of ETF trading volume. And so huge interest into this product. And so for Asia Pacific, now people can trade virtual assets in Hong Kong as well as Australia.
Does that mean that we could see more offerings and more availability for the wider public to access these assets?
I think that's definitely true. If we look at the Australian market across ETFs, it's mainly dominated by advisors. So advisors hold roughly 70 to 90% of the market share. And so now for retail investors in Australia, they can now access virtual assets via the ETF. Ultimately, it's a lot easier to access Bitcoin via an ETF as opposed to the coin directly, because you have to open a cold storage, you have to have a wallet, and oftentimes you have to worry about the various exchanges being hacked. But now that it's offered through an ETF format, it makes it safe, regulated, and trading on an exchange. And so in terms of product offering, now that we have spot Bitcoin, we could expect to see baskets coming. We could expect to see leverage in inverse product. We could see it being adopted into portfolios. And so an estimate that people said is if we look at the entire advisory model, even if you allocate 1% into cryptocurrencies, this would be a huge impact. And so that's why across Australia, we think that it could have as much as a $1 billion impact. If we look at the Australian market specifically, they are currently ranked 4th across Asia Pacific by assets under management. So they have roughly $125 billion. And one of the leading ETF issuers in Australia is BetaShares. And they've recently had a $300 million investment by Temasek in Singapore. They've launched BetaShares Direct, which is the retail platform that offers free trading for ETFs for all of their investors. They made an acquisition into Bendigo and Adeline Bank into superannuation. So the Australian market is very interested and invest into ETFs on a regular basis. So this is another product offering that shows the growth potential that Australia has.
Yep. Bloomberg Intelligence ETF analyst Rebecca Sin there with the latest on what we can expect in the crypto space across Asia. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. Not a strong lead given that we didn't have any trading on Wall Street, but we'll be watching the loan prime rate out of China. Haidi, of course, we have heard from PBOC Governor Pan Gongsheng talking about a big reform and overhaul coming to their policy toolkits.
That's right, potentially new tools for the PBOC when it comes to the management of the bond market. So watching China bonds today, but of course, sort of pouring cold water on any kind of traditional quantitative easing that might have still been expected by markets from China.
And coming at a time, of course, when authorities really need some sort of funding in order to help the local governments, right? And sort of the same feeling here in Japan as well, as we're getting the BOG's shift when it came to that policy decision last week of cutting debt purchases. And now the finance minister coming out saying that they want to shift their bond issuance to shorter maturities, according to a draft proposal that Bloomberg took a look at. And when we had that report out, we actually saw JGBs take a little bit of a hit. Of course, we have seen a lot of volatility already in the bond markets. Governor Ueda in Parliament talking about keeping the door open for July rate hike together with a reduction of those debt purchases. And you can see the volatility across markets. The Nikkei down 0.3%, reversing those 2 sessions of gains. The Topics is also down 0.25%. We're waiting for the open in South Korea as well. We have seen the huge tech rally taking the Kospi to the highest level since 2022. This is the open in the South Korea market. If we can get that board up, we can see if we're going to continue with that push higher, up 0.1%, while the Korean won is really holding steady at that 1382 level. Haidi.
taking a look at the start of the Open. And of course, front and center will be that midday debut of Guzman y Gomez, the Burrito chain, of course, set to be really one of the biggest IPOs that Australia has seen after what has been really a pretty arid environment for these kinds of listings and deals. But pretty flat start to trading at the moment. The ASX 200 just sort of creeping online in that staggered open. The Aussie dollar is holding pretty steady at 66.72. We have had a little bit of weakness, of course, coming from the haven demand that we've seen across dollar demand there as well. But at the moment, we're holding pretty much unchanged at this point. We are looking at, of course, when it comes to FX, a little bit more positioning ahead of the Swiss National Bank meeting and a lot more of that Eurocentric focus with the central bank activity there. Taking a look at treasuries as well, where we have seen really US treasuries on the brink of some pretty big moves, just a whisker away from erasing the losses that we've seen across 2024 on these rates bets. The treasury gauge was down as much as 3.5% for the year in April. We've certainly come off that, but a lot of markets have seen that peak when it comes to US government bond yields for sure. And finally, a look at the oil markets. And this picture is a pretty steadying picture there for Brent. We're seeing a little bit of upside of $85 a barrel there for Brent. The volatility for Brent has kind of given way to what is now really a multi-year low volume session over the US holiday, and really not much of a movement and not much of a trigger though. We're looking at a monthly gain for crude though after those extended supply cuts from OPEC+.
And Haidi, let's bring in our next guest who says extremely muted market volatility is making hedging strategies attractive. Joining us now is Kristen Bitterly, Head of Investment Solutions at Citi Wealth. Kristen, great to have you with us. So what sort of hedging solutions are you looking at right now?
So one of the number one questions that we're receiving from clients within the U.S. market and around the globe is just looking at the number of indices that have hit all-time highs or year-to-date highs. How should you think about your exposure going into the second half of the year? And I think instead of simply saying I'm either all in the market or all out of the market, diversification certainly works. We see that there are areas within portfolios, both for equity exposure as well as fixed income exposure. But I think when we look at the volatility backdrop, particularly within the U.S. market, volatility has remained relatively muted. That combined with elevated interest rates means that outright hedges are relatively cheap. And so for investors who are worried about everything from geopolitics to elections later in this year, this is a way to stay confidently invested.
We have seen, of course, that narrow rally across the world, especially focused on tech and that frenzy over artificial intelligence. Is that a sector that you would still advise your clients to get into at this point, given the potential for long-term growth?
I think you have to look at it two different ways. We have within our outlook, and we refocused on this in our mid-year outlook, the fact that you want exposure to some of these names. So whether it's the Magnificent Seven or really kind of a reduction into those three top names that have performed very well, there is something to the fact that these are large free cash flow generating companies that are consistently investing back into their business and that they have been able to deliver on earnings. However, we know that the moment that the market sees that if you're not beating estimates and then raising guidance, those names can be punished as well. So what we're looking at is more of like a balancing. So look at the S&P 500 equal weighted index, for example. That's a way of still having exposure, but playing the broadening out that since we have seen resilient earnings and resilient economic data that we believe is going to come to pass within the second half of this year.
Do you go, for example, into tech in other regions? Because I've heard a lot of positivity coming about Chinese tech, for example, that has been really battered by this investor bearishness overall in China. But at the same time, these tech companies might be a good bargain at this point.
I think in terms of expanding the theme about global diversification, so it's not just diversification in terms of equities and fixed income, it's also looking at opportunities in the global market. Security selection clearly matters here. Fundamentals matter as well. And so we do see opportunities for adding some exposure within these themes. And it's not just when we look at these long-term secular growth trends. Yes, AI, the rise of digitization is one of them. But I also think investing in themes like longevity and healthcare, these are themes that are not uniquely U.S., but have exposure globally. And so whether it's in markets locally here in Asia, Japan has obviously been receiving so much attention given some of the recent changes that we've seen. So security selection matters, and I think those themes are global in nature, so it merits exposure.
It is an area that has perhaps higher than usual levels of volatility, right? Biotech and pharma. So how do you recommend getting exposure to that?
Great question. When we look at last year particularly, last year was actually the story of really only 2 pharma companies, and those companies that were on the forefront of the innovation when it comes to the GLP-1 drugs. And so when we look this year, biotech has had some volatility. It's largely been driven by the interest rate environment and interest rate expectations. So as we see M&A pick up in that space, those are areas where we do believe that there are opportunities within biotech. But I think taking a step back and saying healthcare, not everything is created equal. When you look at the subsectors within healthcare, areas like medtech, life sciences, looking at the trend that the population above 65 is expected to double by 2030, the population over 80 is expected to triple. The #1 determinant of your consumption of healthcare is your age. And so really playing the long game in terms of broadening out and having exposure to areas like life sciences and medtech, that from a valuation perspective, there's a massive disconnect between what we've seen in those 2 large companies.
What are the kind of most compelling thematics for you when it comes to Asia?
So Japan is something that I mentioned. I've been in the region, traveling in Hong Kong and Singapore, hosting various events with our clients. I think Japan is one of those questions. It continues to get interest, and for good reason, because this is really, a once-in-a-generation type transformation. I think when we look at the valuations on a forward PE basis, trading around 15 times compared to the U.S. market that's obviously trading at a premium, and you add that combined with corporate governance, I think there's a lot of reasons why we think that this rally could actually continue higher. Obviously, this is a very elegant dance, and I heard you speaking earlier about some of the auctions. It's an elegant dance when it comes to, you want that moderate type inflation, sustainable moderate inflation. And so when we look at the investment opportunities within the Japanese market, of course, because you're going to have continued pressure on wages with that, you're going to want the companies with pricing power and also the ones who are going to be the beneficiaries of this corporate reform when it comes to governance.
How much interest or past caution are you seeing around private credit right now?
So we've actually seen, I think within the private credit market, it's been one of the major headlines. We've seen substantial interest. I think it's a question of really manager selection and making sure that the opportunity, the exposure that you have is in line with expectations. So, if we ask about one of the risks that's on the horizon, one of the risks on the horizon is that we have higher interest rates for longer, and we really come upon that maturity wall when it comes to any type of company that is exposed to the short end of the curve. So you want to be exposed to managers who have the ability to capitalize on that. But that being said, when we look at the changes in the industry overall, when you look at private capital coming in and being able to be a lender in areas of growth where banks are no longer that primary lender, I think there's plenty of opportunity, but manager selection is clearly key in this space.
Kristen Betterly, who's a head of investment solutions at Citi Wealth. Let's take a look at one of the stocks that we're watching is ESCO Innovation at the moment. Take a look at where we're seeing moves of close to 15% at this point. We're seeing that big jump after a report of a merger with SK E&S, according to reporting in Chosun Ilbo. SK Group is reportedly approving the merger of SK Innovation and SK E&S at a meeting between June 28th and 29th. That's set to be approved, I should say. That would create an energy company with an asset of 106 trillion won, covering the likes of oil, gas to renewables. We could also see after the merger the battery unit merging with the power generation and LNG sales units as well. So we wait to see whether that comes to fruition in that meeting towards the end of the month. But that is that report why we're seeing that big jump in SK Innovation. More ahead on the Asia trade. This is Bloomberg.
You're watching the Asia Trade. Vietnam has welcomed Russian President Vladimir Putin after he arrived in Hanoi on Thursday following his visit to North Korea. Our East Asia government editor John Herskovitz joins me now with the latest. And of course, North Korea, Vietnam and Russia have had this decades-old relationship. Tell us a little bit about how the Russian president visiting Vietnam fits into this bigger picture.
Yeah, we're seeing a real push from Putin into Asia, going to these former allies of the Soviet Union, North Korea and Vietnam. The visits serve that one purpose of extending Russia's presence in the region, and both countries, North Korea and Vietnam, serve different purposes for Putin. For North Korea, it's arms for his war in Ukraine. For Vietnam, it's more of a balancing power between China, the U.S., and just getting assurances for some of the investments that Russia has there, and to help Vietnam with its energy sector, of which Russia is trying to be a player.
It's a very interesting position for Vietnam to be in, because for decades, it's really partnered with Russia, but at the same time, it's achieved such economic growth by working with Western partners as well.
Exactly. Vietnam has looked to the U.S. In fact, it's gotten arms from the U.S. in recent years. It's had affiliations with China, and then there's the old Soviet Union connection. So Vietnam is looking at a variety of players from the West, from Asia, and now Russia's asserting itself a bit more. They've been neutral towards Putin. They're hosting him now, so that increases the Russian presence there and the balance that Vietnam plays with so many different powers.
How does China play into this? Because it's got its own issues with Vietnam as well.
Exactly. It's difficult for China. And we have the oil exploration in the South China Sea. Vietnam is trying to do more there, and it's good if it can get Russia's help with security. If you're worried about Chinese patrol boats coming by, the idea that you have Russia in your back pocket can help with Vietnam. And China is also looking at the North Korea relations, which have been recalibrated since Kim Jong-un and Putin have really developed this friendship, which turned into what Kim said was a military alliance with this mutual security pact that came out of their summit. So there's a lot going on, and China's been a bit to the side because of this trip.
So all in all, how do we sort of assess the outcome of this meeting? Would it be taken by both sides as being a success?
I think for Putin, anytime he can make these international outreaches and show in a show of defiance against the U.S. and its partners, that would be seen as a victory for him. For Kim Jong-un, this was it's going to be billed by his state media as a triumphant visit, but it also brings aid and security for him. For Vietnam as well, it helps them in their geopolitical calculations. They can play one off against the other, and they have a bigger Russian card to play than they did before the visit.
East Asia government editor John Herskovitz there. Well, China is said to be preparing a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. The likely targets include alcohol, cars, many different food items as well. Let's bring our Chief North Asia correspondent Stephen Engel in Hong Kong. So, Steve, I suppose the question is, is this, as a lot of people are worried about, the beginnings of another trade war? Are these going to be pretty selective tariffs that are more symbolic than anything?
I don't think they're necessarily symbolic. They're going to be hitting products that are going to hurt the EU more than it's going to hurt China. They're going to target areas where China can source from other areas, and that means like wine as well as foodstuff. So you can see what many speculate to be the key areas. France would be hit hard with brandy. China is France's second largest brandy export market, and there's already been a investigation that has been launched on that front back in January. Those investigations usually last about a year, but that does not mean there cannot be some preliminary tariffs levied on brandy imports into China, much like what China did with its tariffs on wine from Australia during that trade friction. and I mentioned wine, of course, then the Mediterranean nations like France, like Italy, like Spain could potentially be hurt. Keep in mind, Heidi, there is a historic global glut of wine right now. So if China wants to import more wine, they can go elsewhere. South America, they can go back to Australia, obviously. So again, it won't necessarily hurt China. It's going to hurt the European producers. Dairy, that's another one. Danish producers could potentially be hit hard. Pork, that's Spain's big export product, obviously, and China is the #2 export destination for Spanish pork. And then there's cars. Obviously the biggest export product from Germany are automobiles. CCTV, state media in China, is already reporting, saying that Chinese car makers have urged Beijing, I should say, to adopt the most severe, quote-unquote, measures, including potentially a 25% tax on EU-made cars with large engines. So yeah, this could get very interesting.
You said, these are products that are going to hurt the EU more than China. Are they products that they potentially are avoiding for Beijing?
Well, what's the big export product out of the EU? Toulouse, France, and elsewhere. It's the big Airbus aircraft, of course. And Airbus does have a single-aisle assembly plant in Tianjin. But right now, Chinese airlines are in negotiation for about 100 wide-body planes from the EU. So it would be highly unlikely that China would impose tariffs on products that it desperately needs. There's only there's a duopoly, really, China and the United States, the EU and the United States, between Airbus and Boeing. So if you slap a bunch of tariffs onto Airbus, that helps Boeing, but that does not necessarily play into the geopolitical tension that is rising between China and the United States. And look, China needs these aircrafts. They're in negotiations to buy one. It might be a carrot and stick approach as far as offering a carrot in negotiations against those EV tariffs. But again, that's unlikely to be in at least the first round of any kind of escalating tariffs, if that does happen.
Our Chief North Asia correspondent Stephen Angle there in Hong Kong with the latest. And some of the other stories we're following today across geopolitics. And US intelligence sources say they believe China's leaders have no clear favourite between Joe Biden and Donald Trump in their likely presidential election rematch. The US assessment is matched by interviews with Beijing officials who think both candidates are intent on containing China. While Trump has threatened higher tariffs, Biden is seen as pushing regional alliances against China's rise. Chinese President Xi Jinping has called for greater loyalty and discipline in the country's military. Speaking in the city of Yan'an, which is a stronghold of the Communist Party, he also called for tighter policing of graft. At least a dozen senior military officials were removed from their posts last year in a corruption crackdown. Former US House Speaker Nancy Pelosi is accusing China of trying to erase Tibetan culture. She and other US lawmakers met with the Dalai Lama in the Indian town of Dharamshala on Wednesday. Pelosi also says the recently passed bill on Congress strengthening US support for Tibet sends a strong message to China. Beijing has condemned the visit. More ahead on the Asia trade, this is Bloomberg.
You're watching the Asia trade. Take a look at how JGBs are trading at the moment. We didn't get any lead from Wall Street given that treasuries weren't trading on a holiday. But we had seen JGBs take a slight hit after Bloomberg reported that the Ministry of Finance is weighing a plan to shift more issuance to shorter maturity bonds. As discussed with Asia Economy Senior Editor Brian Fowler. Brian, how significant would this move be?
Yeah, it's a really big move, Shery, and it comes against the backdrop of all the other policy changes we're seeing. So, of course, for the longest time, for decades, Japan interest rates, policy rates have been on either side of zero, and long-term rates have been capped thanks to the YCC program that the BOJ kept until March of this year. Now the BOJ has said it's going to cut its bond buying, and so the MOF needs to find a wider pool of potential buyers for debt. And this proposal to shorten maturities is specifically aimed at banks. Banks are much more likely to buy shorter-term JGBs than longer-term because it's much easier from a risk management perspective to make those purchases.
Are there any implications here for the Japanese yen potentially?
Yeah, so I mean, it's potential. It's possible that if these banks now are less inclined to go overseas to buy treasuries and instead channel those funds into JGBs, that could be a potential positive for the yen. And for that matter, you know, we could see more funds coming in from overseas into yen to buy JGBs. We'll see that. It could also affect the yield curve. In theory, if there's less demand at the long end, like the 40-year, say, those rates could come down and there could be a little bit of a higher rate action at the short end. We'll have to wait and see how that plays out. But we expect to have all this proposal approved on Friday, and we'll know more then.
Could we see a bit of a risk when it comes to today's 5-year auction? Does this pose a potential risk to the entire yield curve, or do you expect the market reaction ultimately, if we get more information, to be more subdued?
Yeah, well, Heidi, that's a huge question. And so when the BOJ first said it was going to cut its bond buying, the first question, which we didn't get an answer to, was, well, how fast? How much are they going to cut? We will get that answer on July 31st, but we asked the question because it's not really clear how much extra buying power there is at the banks. Will the banks be able to absorb the bonds that the BOJ is no longer buying? And you know, the answer to that question, we'll see that in the bond auctions. If demand is not there, those auctions are not going to go very well. And so I think that's one thing MOF is trying to get ahead of, trying to figure out a way, and so part of the proposal is floating rate debt, which at this point is not there for banks. Maybe that would be more appealing to the banks.
And we saw a little bit more volatility in the bond markets this week as well, because we got some more commentary from Governor Ueda in Parliament, right? I mean, what does it mean leaving the door open for a July rate hike, but also at the same time doing those reductions in bond purchases?
Yeah, so there was a big question. As soon as they announced that they were going to cut buying, but then refrained from giving us the details, a number of economists said, well, that makes it less likely that there's going to be a hike in July, because that would be a pretty big double policy thing to do in one go. However, there's another case. I mean, Ueda, his comments since that last press conference have been a little bit unusual. He, when asked about the possibility of a July rate increase, his response was, of course, which is unusually an unusual degree of confidence coming from him. He's usually he waffles a bit. He's very academic. So the chances, it's going to be a live meeting for rates in July, and right now it looks like 50-50 that there could be a hike.
Yeah, the Japanese yen, the treading water as we await for that decision as well. Our Asia Economy and Government Senior Editor Brian Fowler there with the latest on the BOJ and the FINMI's moves when it comes to the bond market. We have more ahead on the Asia trade. This is Bloomberg.
About 30 minutes into trading here in Asia, the top stories that you should know. China is said to be readying a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. The likely targets may include alcohol, cars, and many different food items. Watching US Treasuries as well as cash trading resumes. The Bloomberg gauge of returns in the asset class now down just 0.1% for 2024. That's as investors bet that cooling inflation will convince the Fed to cut sooner and by more than what officials have signaled. A draft proposal seen by Bloomberg shows that Japan's Ministry of Finance is weighing a plan to shift more of its bond issuance to shorter maturities. It's a major change as the central bank moves to cut purchases of government debt.
Let's stay on Japan because Nori Chunking is now eyeing assets, including CLOs, given, of course, the massive losses that we've seen already for the bank, and it's selling $63 billion in bonds in order to stem those assets for losses. For more, let's bring in our Asia credit editor, Finbar Flynn. And Finbar, of course, we continue to watch this story as slowly as it's moving because it just gives you a bigger picture of the implications of a bank making the wrong bets when it comes to interest rate policy. What's new right now that could potentially mean more trouble for Japan?
So you put your finger on it there, Shery, that we've seen banks get into trouble with this interest rate risk before, and Norinchukin is now in the spotlight, basically. What Norinchukin is trying to do is it said it's going to try to get rid of, or at least cut a major part of its sovereign bond holdings in dollars and euros. And they're going to try to shift more into credit products and CLOs. So they're trying to reduce one risk, which is interest rate risk, but they're going to move that money into credit risk.
How difficult, challenging, and tricky is it to move from one asset and bets in that sector to another?
Well, in terms of Norinchukin, they're saying they're going to reduce 63 billion. And the big difference with corporate credit markets is they are large, but they're not as liquid as government debt markets. And that's especially the case for CLOs. I mean, Norinchukin is known as the whale in that market, but that's a large market. But trying to take large positions, they have been known to shift the entire market, just sitting on the sides of coming back in.
That was my next question. What are the market implications then? Because this is a big chunk of change.
It is indeed. I think now is not the best timing for them to come into this market in terms of credit. Credit has been very stable for the last 18 months since SVB notably had its troubles and collapsed last year. But spreads have started to widen, and people are a little bit nervous in the credit markets right now just because those spreads in junk and in investment grade are beginning to widen from record lows here in Asia at the very least.
How worried are officials about the situation?
So here in Japan, officials have been saying that SVB, or I should say Norinchukin, is not a worry, that there are paper losses, that the losses that they have are, I suppose they've said it's like 1.5 trillion yen, which is 3 times more than they'd said. But this is a very, very large bank. So they have like close to 360 billion in investments alone. So for now, concerns aren't huge here in Japan about the bank's stability, and the bank has said that themselves as well. They have a very stable deposit base, which is also super important.
Our Asia credit editor, Finn Barflin there. And taking a look at one of the key themes that we're watching, which is trading in Chinese government bonds. Have massively beaten their peers in the US, in Japan, in Germany. And of course, it's such a contrast what we've seen with the equity markets. Basically, no inflation. That's been a major driver of positive returns. And bond investors could also be buying on hopes of some sort of QE, which is particularly interesting given what we've heard from the PBOC governor. Let's bring in Hao Hong, who's a partner and chief economist at Grow Investment Group. So, we were chatting a little bit earlier. There's so much to talk about when it comes to China at the moment, when isn't there much to talk about? But let's start off with the PBOC governor's comments. Does it suggest to you there's some sort of mulling of perhaps not traditional QE, but certainly something more strategic to come here?
Yeah, well, I think we were expecting the PBOC to cut rates when it was, renewing the MIF facility. But it didn't, right? But, at this stage, even when the PBOC has been cutting its rates, but, the steps has been rather cautious, right? We're only doing 10 bips or 10 bips at a time, rather than 25, 33 bips at a time, like it used to be. So it's showing you that the PBOC governor is concerned about the pressure on the Chinese yuan. Yesterday's at the Lujiazui Forum, we've seen the speech from Mr. Pan, the PBOC governor. Basically, he's saying that at this stage, the currency stability is actually a more important policy goal than interest rate. So I think at this stage, because the U.S. Fed is still delaying its interest rate cut, and therefore, it sort of limits the PBOC's room to cut its own rate.
Does this address the broader issue of confidence, though?
I think, if you look at the market interest rates have been falling, right? So just now, Heidi mentioned that, the Chinese bond is actually the best performing major treasury bonds in the world. I think, with the menace of the property bubble still going on, right? So the property bubble is still deflating, right? For example, in the month of May, we're seeing across all major cities, 100 cities, all the cities is registering price deflation, right? In every single one of the cities, it only happened. It's the first time in history, right? So it's showing you that if the property problem is not resolved, then the disinflation or even deflationary pressure on the Chinese economy will continue.
Even though we are seeing those pressures on the economy, though, we have seen the markets be able to outperform in this environment. Could we see that continue with the equity markets rally?
Yeah, I think the Chinese stocks had a good bounce back since April, especially the Hong Kong stock. And also, yesterday during the forum when the PBOC governor was giving its speech, Hong Kong stocks actually rallied. So if you look at the price, the valuation premium between A and H share is lower to its lowest level in probably 12 months. And there is a high possibility that it will continue this trend. So it is telling us that, especially the offshore market, right? So the ADRs and also the Hong Kong market is beginning to look away from some of the secular issues that the China is still plagued with, and look beyond that. All right. So because those are the issues that you can't resolve immediately. All right. So you have to focus on some of the parts of the economy that is doing relatively okay. For example, retail sales, exports. These are the sectors that have been doing relatively okay.
The underconsumption, the lack of domestic demand is still a problem. Will any changes in policy making coming from the central bank side of things help change that?
Yeah, that is another sort of a structural issue that the Chinese economy is facing. I think, the reason being China has been using investment to drive its growth. And it has been there for like past 20, 30 years since the reform in open. It's unlikely to sort of change in the near term, because China still need to produce 5% growth. And, with the investment capacity investment in the economy still going strong, it's one of the ways to, keep the economy steady. And also, if you look at the Chinese culture, right, the Chinese people has been saving like 40-50% of national savings rate for as long as I can remember, right? So similar things happen to Germany, for example, and also to Japanese as well. So, one shouldn't be surprised to see, China continue to be investment-driven growth, and consumption is important, but, and also it will rise in importance, but it may not be the most important driver in the near term.
And it's interesting, you've pointed out the fact that somehow the spiralling property price, which is such a big story in household wealth in China, has mostly spared consumption and retail demand. Do you expect this to be kind of a theme that has a decorrelation that has longevity, or eventually will that lack of confidence in the property sector create that broader economic and confidence malaise?
Yeah, I think right now we're actually seeing falling property price has little effect on retail sales. So if you look at the retail sales growth and property price deflationary trend, it's been splitting. I think the reason being, when a Chinese family buys its own house, they tend to put down 60% down payment, sometimes 80%. And there are many stories about more than 20-25% of Chinese households, when they buy their own properties, they actually use all cash. Right, so it's just phenomenal. So in this sense, even though the housing price is falling, I think for a Chinese household, because the household is living in this property, and so I think as a result, the falling price has minimum impact on the family's budget, and then as a result, it has sort of a limited impact on retail sales.
When you take a look at the sort of longer-term demographic challenges and the structural challenges that are undeniable for China, do you get the sense that policymakers are sort of, and market bulls are kind of just happy to kick the can down the road? If you look at the longer-term challenges, how do you, I guess, build a portfolio that is resilient against that in some way?
Yeah, I think that's a longer-term challenge for the Chinese society, and also for any society in the world as well. Because birth rate has been falling across the world, not just in China. But I think China is falling faster and facing a bigger challenge because of the one-child policy that's been practicing since the 1980s. I think at this stage, if you look at how the younger Chinese is thinking about the future, actually the willingness to get married and have kids is declining, not rising. For example, people registered to get married this year in Shanghai during the May 20th festival, the Chinese sort of Valentine's Day, is at a historic low as well, right? So it's not looking great for the young couples. So I think going into the future, I think things that the Chinese government can do to help people to form family is that, for example, it should continue to control property price inflation or make housing cheaper for younger couples. For example, because there's excess inventory in the market, so when people register to get married, maybe they should give some subsidies, some coupons, housing coupons, for people, make it easier for people to buy property. And when people have kids, they can offer free education for the kids all the way to 18, etc., etc. So it makes it easier and more affordable for young couples to have kids and get married. So I think those are the things that the government should be doing. And I think in July, obviously, we're having a very important meeting on the calendar. Hopefully, we can hear more about, future longer-term development strategy from the government.
Hao Hong, partner and chief economist at Grow Investment Group with everything to do with China. As we set up for that markets open, take a look at how Asia is trading right now. It's a little bit of a mixed picture because we're seeing the Nikkei now fall for the first time in 3 sessions. We have real estate and tech leading those declines. Although the Kospi is still gaining 0.1%, extending those gains. We're already at the highest level since January of 2022. We do watch out for SK Innovation, which is jumping at the moment given merger news with SK ENS, and also the ASX 200 at the moment under a little bit of pressure as Kiwi stocks are also higher. They just avoided technical recession. More ahead on the Asia trade. This is Bloomberg.
Well, Mexican restaurant chain started by an American expat is set to list on the Australian Stock Exchange today with a valuation of $1.5 billion. Equity capital markets reporter Felipe Pacheco joins us now. So this is pretty significant for the Aussie market.
That's right, Heidi. We haven't seen an IPO at this size in the Australian market for nearly 1 year, especially from this sector. Food and beverage is not, we haven't seen many deals that would actually give investors the opportunity to build exposure to such a chain. And then we are talking about a company, Guzman y Gomez, that is quite unique, let's say, within the Australian market and also within the region. They are famous for their burritos, for their bowls. It's Mexican food. It's considered fast food in a very, very growing market. So it will be interesting to see how the stock performs at the beginning of trade at 12 p.m. Sydney time today.
Felipe, if you're like me living in Asia, you're really going to miss Latin American food, aren't you? Are we going to see some of these proceeds going to more expansion and perhaps more of these chain stores in our countries as well?
Shery, we definitely mix. I'm in Hong Kong. We don't have a unit of Guzman y Gomez here. And I've been talking to colleagues in Singapore, also, of course, in Australia, and even in Tokyo, where you are right now. They all have units of this company that's going to become public today. And they are very ambitious. They want to expand. They want to open 30 to 40 units in Australia over the next 10 years. They want to reach a mark of 1,000 stores. That's pretty much what McDonald's has right now in Australia. So a lot of these ambition is going to be funded by this IPO. The company is basically taking around 200 million Australian dollars to invest in growth. And it's quite interesting to actually talk to some analysts and to read some of the reports about this IPO. And a lot of people are quite skeptical that they will be able to deliver this growth as they are promising. So I think that once this stock starts trading, this is going to become quite clear. The intentions that the company have, what they've been selling to the market, and how the market is actually buying it.
And I suppose it gives some context to where they're going in their strategy if you consider the people behind it, right? These are not sort of F&B background. This is actually, at least one of the founders is a hedge fund trader.
That's right, Haidi. It's a very curious start to the company. Stephen Marks, one of the founders, he is a New Yorker. He came to Australia around the early 2000s. He opened the first unit of Guzman y Gomez in 2006. And one of our colleagues spoke to him. We have a quite nice story out there published this morning about how he created this burrito empire and how he became very rich with it. He used to be an equities trader. He has a background in the hedge fund industry, and his childhood friend that started the company with him had a background in fashion wholesale. So we are not talking about a typical Mexican family that started a little restaurant on the backyard and became big. This was actually thought to be a Mexican food chain since the very beginning, and we can see it growing quite quickly, especially with this IPO now.
Yeah, definitely going to try it out. Equity Capital Markets reporter Felipe Pacheco there with the latest on Guzman y Gomez. I'm going to head out to one of those shops here in Tokyo. But let's turn to the ETF investing directly in Bitcoin, which will list on Australia's main stock market for the first time today. Bloomberg Intelligence says that could help bring nearly $1 billion of assets into the nation's virtual asset ETFs. BI ETF analyst Rebecca Sin joins us now with the latest, and we're talking about the VanEck Bitcoin ETF that's having its Thursday debut. How significant is this in terms of the change that we're seeing around the crypto space and its access to just retail investors?
So this is a significant move for Australia, especially since this is being listed on the ASX. In Australia, there's two main exchanges, the ASX and the CBOE. But ultimately, ASX gets roughly 70 to 80% of the flows across the exchange. So we could see as much as $1 billion worth of ETF coming from the crypto space into Australia. So this is a huge move for Australia. 2 years ago, they launched the spot Bitcoin and Ether ETF on the CBOE Australia exchange, but we've only seen roughly 88 million of flows come into that. And so with VanEck's ETF being listed on ASX, we expect to see significant more flows because it's the larger exchange. In Australia, there's a huge advisor model, and we expect that a lot of advisors will start allocating into this ETF. Especially, there's been a lot of interest in virtual assets this year with the launch of spot Bitcoin ETF in the U.S. Virtual assets have gathered more than 100 billion in assets globally, and so there's huge demand for this product.
What are we seeing in the pipeline then if there is so much huge demand, and you say Australia is one of the three kind of key markets that could see the split of this?
So across Asia Pacific, we're expecting to see roughly $3 billion in assets, $1 billion coming from Hong Kong. In April earlier this year, Hong Kong launched the spot Bitcoin and Ether ETF, and we have 3 ETF issuers. Korea is another market where we see a lot of growth potential. The main reason is Korean investors are already investing into virtual assets in the U.S. So there's the leverage inverse, the ProShares Burrito ETF, they invest into spot Bitcoin. And so the demand is growing. Where we expect the market to go next is ultimately more product offerings. So for instance, we we could see leverage in inverse product. In Asia, that's a very popular product. I think in Hong Kong, we're going to see some leverage in inverse ETFs coming up from CSOP. We could see baskets of virtual assets, so baskets containing both Bitcoin, Ether, Solana, and other coins that we haven't seen before. All of these ETFs currently are just single stocks, single underlying, but we could start seeing more. But if you do want to hear more about where we think the crypto market is going, we do have a podcast called Tiger Money, where we interview the CEO and founder of 21 Shares, which is one of the largest crypto funds across the world.
Bloomberg Intelligence ETF analyst Rebecca Sin there joining us. More to come here on the Asia Trade. This is Bloomberg.
And Heidi, here's a story that our viewers will really care about. JP Morgan now joining Goldman Sachs and strapping the cap on bonuses when it comes to UK bankers. Now, this is according to people speaking to Bloomberg, saying that the move will allow JP Morgan's bankers to earn a bonus that's as much as 10 times their base salary. That's up from a current limit that restricts certain employees' bonuses to 2 times their fixed pay, and comes after, of course, the UK government last year lifted its long-time cap on bankers' bonuses.
Well, those bonuses could come down further if this forecast comes true. Citi sees AI displacing more finance jobs than in any other sector. They see about 54% of jobs in banking and finance as having the high potential to be automated. On the other side, though, there could be more roles for AI managers and compliance staff to make sure that this technology is being used. So they also see an additional 12% of roles across the industry being augmented by the technology, according to Citigroup. So we've already seen some of the world's biggest banks slowly beginning to experiment with more AI over the last year to try and boost productivity and cut costs. Citi, for example, wanting to equip just 40,000 coders with the ability to experiment with different AI technologies. So AI continuing to permeate these outlooks. Today's Big Take also focuses on jobs for finance professionals, taking a look at how Point72, Citadel have pioneered hedge fund boot camps to mint star traders. Subscribers can read that. More on that on the terminal, and our Big Take is the function. It's also on Bloomberg.com. This is Bloomberg.